Many people think you need thousands to get started investing, but the truth is you don't. You can get started with whatever you have and then scale up. You don't have to wait to get on your journey to building wealth. Today, I'm going to show you what investing $50, $200 per month can turn into after 10, 20, or 30 years. I'm going to be using a blended average of these funds right here, QQQM. I have QQQ on my chart because it's been around longer, since 1999. So I use it for tracking and trading, not investing, because it has a higher expense ratio than QQQM. The other funds I have here are SCHG, SPMO, and SPYM. And we'll be using an average from these four powerful ETFs that will have you on track for growth. So I often see in my comments, I wish I started sooner. I wish I hadn't held on to my cash. I'm 40 or 50 just getting started. How can I catch up now? And this video is to show you what consistency can look like. The 10-year rate of return for these funds are between about 17 and 22%. So we're going to use 20% for our average today. Not a prediction. We don't know what the future holds. This is just a simple way of showing the power of compound interest, staying consistent for the long term with that $50 per week, $200 per month. I'll have the investment calculator linked in the description. Let's get started updating it. Starting amount, 0. For the next 10 years at a 20% rate of return, contributing $200 monthly, contributing $24,000 and gaining interest of nearly $44,000. Over 20 years, our portfolio is on track to grow to about $488,000. And then over 30 years, nearly $3.1 million. And this is based on the performance of some funds. You don't need the perfect stock. You don't have to time the market. You just need to show up every single week and stay consistent. Now, the stock market does not move this smoothly and perfectly, but over time, your portfolio will have dips, but it'll be on track to recover when you incorporate quality funds that rebalance for you and keep you on track. And as your portfolio grows, the power of compound interest is working in your favor, doing the heavy lifting, the work for you. Now, back to the funds that I use for our example today. These are not recommendations. These are just 4 different funds that give an illustration of how you can grow with small amounts over time. QQQM tracks the NASDAQ 100. It's tech heavy, innovation driven, and will have you on track for that long-term growth. SPMO is Invesco's S&P 500 Momentum ETF. It follows the S&P 500 Momentum Index, taking 500 companies out of that S&P 500 with that highest momentum score. It rotates in the strongest performers and rebalances twice per year. SPYM tracks the entire S&P 500. It has a low expense ratio of 0.02%, and it gives you simple, broad, reliable market exposure. And then SCHG, which is the Schwab U.S. Large Cap Growth ETF. This one tracks the Dow Jones and is a diversified basket of America's strongest growth companies, also with low fees at 0.04%. Funds like this will have you on track to owning the market. You don't have to chase every individual company. Automation is how you get on track to building your portfolio. Don't wait for the perfect moment. Don't wait for a market drop. Automate a minimum amount right now. $50, $100, whatever fits into your budget, and get that money invested out into the market on track to build and grow. Now, this is just a start. Let's talk about the roadmap to retirement. Taking a look at Fidelity's guidelines, research shows that investing 15% of your income, including your company employer match, if you have one, will have you on track for a potential replacement of 45% of your income in retirement. They're basing this on you contributing from the age of 25 to 67 and withdraw from the age of 67 to potentially 93. So everyone's circumstances are different. If we're going to have a pension, how much Social Security will be. But when the time comes, we have to be ready to withdraw at a low rate, 4 to 5%. In order to make sure that our retirement investments last us. So no matter where you are in your investing journey, all we can do is move forward. We can't go back to when we first graduated from college, got started working, whatever stage of life we were back in our 20s, when we didn't have financial literacy, we didn't know how to contribute to a Roth IRA. All we can do is move forward. Now that we know better, we're going to do better. Even if you are getting started in your 40s or 50s, put the effort in. Something is better than nothing. So get on track to build something additional to go along with any other sources of income that you will have when the day comes that you have to stop working. And let's teach our kids, grandkids, nieces, and nephews to get started earlier. I hope they listen. I truly wish I knew what I know now sooner. Now, let's talk a little bit about the mechanics of how you're actually going to get an investment plan like this accomplished. I happen to use Fidelity for my retirement accounts, and I think that should be everyone's first goal that they prioritize when it comes to investing. So over at Fidelity, I can buy fractional shares, meaning if I am investing that $50 per week, I can buy a piece of a fund like SPMO, which currently has a stock price of $140. I don't have to build up my money waiting to be able to buy full shares. I can be investing with whatever amount that I currently have. They don't have limitations on how much you need to set up your account. You can automate the DRIP, which is the dividend reinvestment plan, so that when those dividends hit your portfolio, they're reinvested to buy you more shares. So make sure you understand your broker. There is so much that can be handled for you automatically. These little settings matter. They make your account work for you after you make that step of consistently depositing and having a strategy of how it's going to be invested. Think long term when it comes to your investing. Zoom out. This is SPYM, the S&P 500 investment that we use in today's example. The S&P 500 is buy and hold forever status when it comes to my portfolio. Yes, the market goes up and the market goes down. What matters is an investment that always recovers. So don't be fearful of investing. It's not about perfection. It's not about being rich. It's about being consistent with what you have, scaling up as your income grows, as you're able to cut expenses and prioritize focusing on the future. Investing can truly change your life, eliminating fear and stress, allowing you to always be able to handle whatever comes up, and having the retirement that you deserve. I'm going to tag some of my videos in the end of some buy and hold investments that I'm building into when it comes to my portfolios. Share any questions that you have on today's video. Comment 50 to encourage those getting started on their investing journey. Never been on the investment calculator? Haven't used it in a while? Take some time to put some numbers in to see what you're on track to achieve when it comes to your investments. I am Lisa J. Stocks. Make sure to subscribe, like, hit that notification bell, hype this video, check out my referral links. Thanks for watching. Okay, bye.